Just when you thought stocks might take a break, no, they rocket higher. Stocks only go up. Clearly, but looking at how hard they go up and constantly, day after day, the question becomes, is a blow off top coming? Because if we do get that blow off top, then we will get a nice market crash, possibly. But maybe it really is just blue skies ahead and we're just headed higher and higher from here. But that's what we're gonna review in this video like we do every week. To start, we got a quote from Bruce Kovner, the legendary market wizard, billionaire hedge fund manager. Through bitter experience, I've learned that a mistaken position correlation is the root of some of the most serious problems in trading. If you have 8 highly correlated positions, then you're really just trading one position that's 8 times as large. And that's an important lesson, especially for those of us that are trading straight stocks, which is what I do. Because at the end of the day, you can try to diversify between stocks, but at the end of the day, they're pretty much going to move together. Now that might be strange me saying that because this strategy that we teach in this free training, which there's a link to in this video and down below in the description and comments, we talk about our momentum strategy and how to pick the 5 best stocks in the NASDAQ. So with that strategy, are we able to beat the market? Yeah, we are. We're up over 40% right now. So yeah, with that strategy, we are able to pick the stocks that are moving higher the fastest compared to the rest of the stocks in the market. So that adds to our returns, obviously, but even more than that, the most important part is the risk control, because we're not blinding ourselves to thinking that, hey, all stocks don't move together, because they really do. So the way you're really going to beat the index and really get out ahead of it is through risk control, so that you're cutting off your downside risk that the rest of the stocks go through. But you can never forget that just because you're picking the 5 best stocks, that doesn't mean they're all going to stay up when the market turns. Most likely they're not. That's when you rotate into cash. So don't fool yourself with the whole diversification thing. And we talked about diversification in that last video. And one of our Fallible members made a beautiful, I don't know what you would call it, a soliloquy? Basically to help remind us how our Fallible strategy works. This is Karsten here who wrote this. And the Lord spake, saying, first shalt thou watch the holy video from AK. Then shalt thou count to 5, no more, no less. 5 shall be the number thou shalt count, and the number of the counting shall be 5. 6 shalt thou not count, neither count thou 4, excepting that thou proceed to 5. 7 is right out. Once the number 5, being the 5th number, be reached, then order the holy 5 stocks of momentum and add to your portfolio and praise the Lord. At least that's how it sounded in my head. Just beautiful. Very beautiful, Karsten. Moving on to markets, Caleb Thomas, a real smart dude, shared a chart from Goldman Sachs on Twitter last week, showing how US equity ownership is broken down by age group. So what's interesting is those people in the 55 and over age group, they've seen their total equity ownership climb from 52% in 1990 to 75% today, which is nuts. They're owning most of the stock in the stock market. And that's part of the reason why we see such a big divide in wealth. The younger people just aren't able to accumulate that wealth like, the people that came before us. And that does become a problem because there does need to be some type of wealth transfer from the older generations to the younger. How you want to do it? Well, that's a huge debate. But all these generational fights that we see, more than anything else, more than social issues, it all comes down to money. And they are the stupidest and funniest fights that you see, even in the comments of these videos. Gen Xers, who everyone ends up calling boomers because I guess old people are just old people, they go after the millennials, calling them useless kids who haven't worked a day in their life. But a lot of the millennials are like, hey, I'm almost 40 years old here. I got a job, 3 kids, back problems. Almost all my hair is gone. I'm pretty much on your side for a lot of these things. Gen Z, those are the guys you want to be yelling at. But Gen Z doesn't care. I mean, they're busy getting programmed by the CCP through TikTok. So they'll end up being our first non-American Americans that'll be the final nail in the coffin of America's downfall. And as I say this, I know I sound like a boomer again, but that's just the circle of life. Moving on, China was actually the country that saved the global economy from slipping into a much more painful and prolonged economic depression following the great financial crisis in 2008. And it was all thanks to their China-sized fiscal stimulus, the biggest stimulus anyone has ever seen. Well, until this point, but we'll get to that. So while they're turning on their liquidity spigots once again to battle the CCPV, their ability to drive that credit growth has diminished, meaning that pumping money into the economy isn't as effective as it once was. You can only build so many ghost towns, high-speed rail lines, and bridges to nowhere before you start to see a negative impulse from investment. And you can see right here in this picture, it's downtrending, which is what you would expect, right? It can only stimulate so much before you need a real economy. Luckily for the markets, though, the rest of the world has aggressively stepped up to the fiscal plate. This right here is Goldman Sachs' summary of the total fiscal easing that we've seen so far this year. And the numbers are just nuts. Like, look at the US right here. We're getting close to 20% of GDP in fiscal easing. And these other countries are not too far behind. It's a heck of a lot of stimulus to keep these wheels turning. And all that stimulus, along with a weakening dollar, which is what it's causing, has helped helped out the emerging markets. So because the US dollar is the reserve currency in our beautiful world, that means that all these foreign countries' debt are usually denominated in USD, meaning when they take out debt in these emerging markets, it's usually in dollars. So that means that that country has to fight the exchange rate. So say they take out $100 in debt, which equals like 50 of their currency. Well, if the dollar grows stronger, all of a sudden, instead of paying 50 back, they might have to pay 75. And that really screws them over because that's on top of interest and everything else. But if the opposite happens and dollar weakens, then instead of paying 50 back, maybe they have to pay 25. And that's extremely helpful. So the strength of the dollar really matters across the world. Weaker dollar is better for a lot of these other countries. And that's an oversimplification, but you get the idea. And this chart right here from HSBC shows that US excess money year over year has a high leading correlation of 5 months to multiple expansion in the SPX, meaning when there's a bunch of excess money in the economy, prices normally go up in the S&P 500. Multiple expansion means P multiples, right? So the P of the equation, the price, that goes up, and that's how the multiple expands. And you can see that correlation here. The red line is the excess money and the black line is the SPX. Well, the SPX multiple. And this is just more proof to say that liquidity drives everything. We talk about this in every single market review. So whenever we ask ourselves, is a crash coming? The next question you gotta ask yourself is the liquidity drying up? If it hasn't dried up, then the most likely answer is that no crash is coming because there's just too much money. Prices are gonna keep getting pushed up. So when it comes to macro, remember, liquidity is always the number one factor you gotta look at. But the question for markets going forward is whether this liquidity hose that we've had so much fun with, just like little kids in the backyard, playing with hose, well, playing with a hose. Little kids don't play with hose. Or maybe they do now. I don't know. I'm an old man. But the question is whether that liquidity hose will continue to spray at full bore. The fiscal side of things is looking a little scary, as if we're not going to get something passed because there's debates over extending additional unemployment benefits, among other things. But HSBC points out that the Fed still has plenty of room to maneuver. And you can see in this chart right here, what they explain is that so far the Fed has only tapped 45% of the total funds from the US Treasury. So if they've only unleashed 45%, they still got ample firepower to combat any deterioration in the financial conditions and risk off waves in the markets. So even if we don't get our fiscal activities together, the Fed has a lot of room. We can move that 45 up to 100. Can we go to 110? What's Powell say? Infinite QE, stopping bears in their tracks? Look at those toned arms from cranking that printer. He's like a sexy Michelle Obama with those arms. And has Teal ever looked better on anyone else? Silly bear, markets are for bulls. Also, nominal policy rates across the emerging market world have fallen to their lowest levels ever. So what happens if this trend continues and the entire world effectively ends up at zero lower bound, meaning everyone's stimulating the heck out of the economy and everyone has like zero interest rates? It's interesting to think about, and it's something that I asked in the last video when we were talking about what Powell has been doing to stimulate the economy. You guys had a lot of great comments about that, but one thing I didn't mention was that it doesn't matter. If everyone's doing the same thing, what is actually happening to the economy? If we're so worried about our debt, right, in the US, but the rest of the countries are doing the exact same, doesn't the baseline kind of move? At the end of the day, it's all just fiat money, right? And trust. That's what our system is based off of. But the actual numbers? Who cares? Maybe we're in this new stupid normal. Just like what the boomers say, how back in the day, milk only cost a nickel and a shoestring. But now what's milk? Like $3-4? Did our economy crumble? I know we're talking about inflation here too. But what is all this? I mean, what are we doing here? Does it matter? Is it all fiat? Comment down below. I know some of you are already angry at the thought of what I just said. And I love to read what you guys think. Speaking of, I know we live in a post-deficits matter world with MMT and all, and MMT is modern monetary theory, where you just print the hell out of everything, print away your problems. But the US fiscal balance sheet is set to reach the peak hit during World War II with the next round of stimulus. You can see that right here, it's getting nuts. So at some point, the US's financing needs will begin to surpass the structural demand for those safe assets, because we gotta sell treasuries to get all this money, right? And we'll have to see that imbalance correct itself either in higher interest rates or a lower dollar. And our bet is on the latter, the dollar falling. And things seem to be shaping up for that move because HSBC's latest survey shows that the USD bears are in ascendancy, meaning most of the respondents to that survey believe that the USD bear trend is nearer to its end than its beginning. And you guys know how sentiment works, right? If we got a lot of people thinking that the dollar won't fall, well then what's likely gonna happen? It's gonna fall, because that's how the market works. Another interesting thing to look at is buybacks, because they have been such a huge part in the growth of the stock market the last 10 years. But you can see right here that buybacks in 2020 are way below the average. And these are announcements, by the way. 2019 was way above the average. So the question will be, can this party keep going without these buybacks? Just one more factor to look at next to liquidity. And really, I would say that buybacks are a consequence of higher liquidity in the market. So this is a bearish sign. And those who think that this huge rise in the stock market doesn't make any sense just aren't looking at the right data points, really. Because what do we have right now? We have record-breaking levels of fiscal easing and stubborn bearish sentiment and positioning coming off record lows, meaning high liquidity and super bearishness. And that's all you need for a strong bull case. That's why the market keeps moving higher. Same thing I said about sentiment, right? If everybody's bearish, there's a lot of money to come back into the market. And that's what's happening now. It's all you got to really look at to remember that the bull is going to be alive for a while. And just looking at the indices right now, you can see that the S&P 500 broke above this previous high. And when I say high, I mean near-term high. So that is a good signal. That resistance was busted through. Now the next resistance is our previous high before this whole CCPV mess. It's looking like we got a clear pathway up until then. And as far as what happens there, well, we don't know. If it breaks that point, super bullish. If it falls or consolidates, it wouldn't be too surprising. But as of right now, it's not looking like there's going to be another huge drop lower. On the NASDAQ here, we're already at new highs, and we have been for a while, right? So there are clear skies ahead. But in the very, very short term, I would like to see the index break above this high set right here on July 13th. That day we finally got a bit of a reversal. And you can see that the price action today pretty much stopped at that same level and reversed. So there is some overhead supply here. Break through that though, and we're all good to run higher. But again, this is very short-term analysis. The long-term trend is still up. So we don't look to be in danger of a blow off top or a market crash just yet. Either way, I'm pretty confident in the strategy we're using over here at Fallible. I myself use it, and a bunch of our Fallible members do as well. Does fantastic on the upside, but it's even better when the market stops dropping, which it eventually will, because that's where that risk control kicks in. And you guys know I will beat the risk control idea to death, because it is the most important thing in investing. Always protect your downside. If you want to learn how, take this free training. Link in this video and down below in the description and comments. You got nothing to lose. You only have something to lose if you don't take it. And if you like this video, make sure you subscribe, because we will keep tracking the market and see what happens. Gotta stay prepared. So subscribe, and I will see you in the next video. Stay fallible out there. Bye.